Today, we will talk about futures contracts. A futures contract is a legal agreement to buy or sell a particular commodity asset or security at a predetermined price at a specified time in the future. A futures contract is a legal agreement to buy or sell a particular commodity asset or security at a predetermined price at a specified time in the future. The buyer of a futures contract is taking on the obligation to buy and receive the underlying asset when the futures contract expires. On the other hand, the seller of the futures contract is taking on the obligation to provide and deliver the underlying asset at the expiration date. Futures contracts are derivative financial contracts that obligate the parties to transact an asset at a predetermined future date and price. The underlying assets can include physical commodities or other financial instruments. Futures can be used for hedging or trade speculation. It is important to note that futures contract and futures refer to the same thing. Futures contracts are standardized, unlike forward contracts, and are traded on a futures exchange. Producers or purchasers of an underlying asset use futures contracts to hedge or guarantee the price at which the commodity is sold or purchased. By using futures contracts, they can ensure they have a buyer and a satisfactory price, hedging against any changes in the market. Since many commodity prices tend to move in predictable patterns, it is possible to make a profit by trading futures, even if one does not have a direct interest in the underlying commodity. Traders and fund managers use futures to bet on the price of the underlying asset. Futures contracts can be used to set prices on any type of commodity or asset, so long as there is a sufficiently large market for it. Some of the most frequently traded types of futures include grain, livestock, energy, currencies, and securities. Futures contracts are priced using a mathematical model that takes into account the current spot price, the risk-free rate of return, time to maturity, storage costs, dividends, dividend yields, and convenience yields. The futures markets are regulated by the Commodity Futures Trading Commission to ensure the integrity of futures market pricing. Retail traders and portfolio managers can trade futures contracts purely for profit, as long as the trade is closed before expiration. A retail trader has little need to receive the underlying asset, such as 1,000 barrels of oil, but they may be interested in capturing a profit on the price moves of oil. It is important to note that futures contracts expire on different dates, so it's important to check the contract specifications before trading them. A futures contract gets its name from the fact that the buyer and seller of the contract are agreeing to a price today for some asset or security that is to be delivered in the future. These two types of derivatives contract function in much the same way, but the main difference is that futures are exchange-traded and have standardized contract specifications, while forwards trade over the counter with terms and contract specifications customized by the two parties involved. Speculators can use futures contracts to bet on the future price of some asset or security, while hedgers use futures to lock in a price today to reduce market uncertainty between now and the time that good is to be delivered or received. Depending on your broker and your account status with that broker, you may be eligible to trade futures. You will require a margin account and be approved to do so. Qualified traders in the U.S. will often have the ability to trade futures on different exchanges such as the Chicago Mercantile Exchange. Here are 5 key takeaways. 1. Futures contracts are financial derivatives that oblige the buyer to purchase some underlying asset, or the seller to sell that asset, at a predetermined future price and date. 2. A futures contract allows an investor to speculate on the direction of a security, commodity, or financial instrument, either long or short, using leverage. 3. Futures are also often used to hedge the price movement of the underlying asset to help prevent losses from unfavorable price changes. 4. There are tradable futures contracts for almost any commodity imaginable, such as grain, livestock, energy, currencies, and even securities. 5. In the United States, futures contracts are regulated by the Commodity Futures Trading Commission, CFTC. Hope this would help. Thanks for watching.